The world's safest asset just blinked. That sounds impossible because at the same time, the United States still issues the global reserve currency. It still pays interest on every dollar of its debt. And it still tells the world its bonds are risk-free. But according to the material you provided, recent U.S. Treasury auctions saw foreign buyers disappear, especially for long-term bonds. That contradiction is the story. And it matters to you because this isn't just about markets or governments. It's about what happens when a system built on confidence quietly switches to obligation. Something still works, but it no longer works the same way. In 2026, roughly $10 trillion worth of U.S. Treasury bonds mature. That's a fact from the content. When bonds mature, there are only two options. The holder rolls them over and continues collecting interest, or they ask for their money back. There is no third option. Now notice the timing. This maturity wall is approaching while U.S. debt is still accumulating at roughly $1 trillion every 70-plus days. The system is accelerating at the exact moment it needs cooperation the most. Here's the detail that should make you pause. When foreign buyers didn't show up, primary dealers, banks like JP Morgan mentioned in the content, were obligated to buy the bonds. That's not enthusiasm, that's a rule kicking in. The fact is the auctions cleared. The inference is that demand was replaced by enforcement, quietly, off camera. And if the world's biggest borrower starts refinancing this way, what happens when the next 10 trillion comes due? The easy mistake is to see this as a one-time auction issue. It's not. The material places this inside a wider pattern. Western economies like the United Kingdom, France, and Germany are already under visible financial strain. The United States looks different only because the pressure arrives later, not because it doesn't exist. The scale is larger, the delay is longer, the consequences are global. Here's the framing that changes how you see it. In 2025 and 2026, close to 30% of all U.S. marketable debt is scheduled to mature, roughly $9 to $10 trillion before new deficits are even counted. This isn't a distant scenario, it's the next window. At the same time, interest costs alone are compounding at roughly $1 trillion every 75 days. This stops being a debt story and becomes a refinancing story under time pressure. Ask the uncomfortable question. If foreign buyers step back at the exact moment this much debt must be rolled over, who absorbs the shock? According to the content, the burden shifts to primary dealers and the Federal Reserve. Banks are obligated to buy. The Fed circulates money with the Treasury. On paper, everything clears. But notice what's missing from that picture, voluntary demand. This is where the story flips, because once refinancing relies less on trust and more on obligation, the system starts behaving differently. Rates rise to force participation. Yield curve control enters the discussion. Dollar devaluation becomes part of the conversation. None of this is announced as crisis management. It's framed as policy. Here's the claim that matters, grounded in the material. Recent Treasury auctions saw no meaningful foreign participation, forcing obligated buyers to step in. And when that happened, yields went up. That detail matters because higher yields are supposed to attract buyers, but in this case, they didn't. The bonds weren't wanted, they were taken. Pause there. In a normal market, higher yields signal opportunity. Here they signal stress. And notice what didn't happen. There was no public acknowledgement that demand failed, no alarm. The system moved on as if nothing changed, but the mechanism underneath did. The meaning sharpens here. If 80 to 90% of this debt is held by traditional banks, as the content suggests is possible, the question isn't whether the bonds get bought. They will. The question is whether the buyers actually want to hold them, or whether the paper just circulates between banks and the Federal Reserve with the understanding that it can always be pulled back. Now watch how fast this escalates. Once yields rise under obligation instead of demand, interest costs accelerate. And interest is already compounding at extraordinary speed. The machine isn't just rolling forward, it's gaining momentum, and momentum matters more than intent. At this stage, the situation becomes historical. Systems rarely break suddenly. They normalize stress first. The material hints at this shift clearly. Unsold treasuries are no longer treated as emergencies. They're absorbed. Obligations activate. Rates adjust. Life continues. This pattern isn't new. It's just bigger. Historically, when governments face refinancing pressure, they reach for the same tools. They suppress rates, they expand balance sheets, they call it stability. The content directly references this, with the Federal Reserve moving toward yield curve control, effectively capping rates to manage borrowing costs. That's not a short-term fix. That's a structural response. Here's the normalization that should unsettle you. What used to signal trouble now gets explained as coordination. The Treasury issues, the Fed absorbs, money circulates back. On spreadsheets, nothing snaps. But in reality, price signals weaken, risk gets mispriced, and the line between financing and monetization starts to blur. This is the escalation hiding in plain sight, because once a system relies on capped rates and forced buyers, reversing course becomes dangerous. Let rates float freely and interest costs explode. Keep suppressing them and currency value comes into question. The pressure doesn't disappear, it transfers. Now the pressure starts stacking quickly. The material lists multiple developments happening at the same time. Foreign buyers pull back from long-term treasuries. BRICS nations pivot toward gold. The Reserve Bank of India dumps roughly $50 billion in treasuries to accumulate gold. These aren't opinions, they're actions described directly in the content. Notice the timing. This is happening inside the same window as the $10 trillion maturity wall. And while this unfolds, debt continues growing at roughly $1 trillion every 70-plus days. Refinancing isn't replacing old debt with stability, it's replacing it with more pressure. Here's where control starts slipping. When too many variables move at once, policymakers lose clean options. Raise rates and interest costs surge. Lower rates and currency value erodes. Force banks to buy and risk concentrates inside the system. Every lever pulled solves one problem and creates another. This is the mini crisis most people miss because it doesn't look like panic. It looks like management, meetings, tools, facilities. But underneath, momentum is building faster than the fixes designed to slow it down. What happens if this continues? Up to now, this can still feel abstract. Bonds, auctions, central banks. But this doesn't stay inside spreadsheets. It reaches ordinary people quietly first. The content asks a simple but telling question. What should an average person do when the dollar shifts in value, not against other paper currencies, but against real assets like gold? On the surface, exchange rates look stable. Day-to-day transactions still work, salaries still arrive, but purchasing power doesn't collapse overnight. It thins. Foreign transfers become harder to plan. Export margins tighten unexpectedly. Savings lose real value while numbers stay the same. Here's the part that lands closest. You don't get a vote on yield curve control. You don't get notified when forced buying replaces real demand. You experience the downstream effects through prices, fees, and uncertainty. That's not politics. That's mechanics. If this feels familiar, say so in the comments, because the most dangerous phase of a financial shift is the one that still feels normal. This is where you have to zoom out. Outrage won't explain this. Mechanisms will. The system behaves this way because of incentives. Banks are obligated to buy. The Fed is positioned to manage yields. The Treasury must refinance at scale. Each actor is doing exactly what it was designed to do. Here's the unsettling insight. When confidence weakens, systems substitute rather than stop. Markets give way to mandates. Price discovery gives way to caps. Voluntary demand gives way to balance sheet absorption. On the surface, this looks stable. Underneath, leverage concentrates. Notice how power shifts. When rates are capped and buyers are compelled, the market stops sending signals. Policy does. That doesn't eliminate risk, it rearranges it. And because the dollar still sits at the center of global trade, pressure gets exported rather than resolved. This is why things can look calm while becoming more fragile. The spectacle stays controlled. The plumbing does not. And the longer this runs, the harder it becomes to unwind without visible damage. From here, the path forward splits. The material hints at two trajectories. One is containment. Rates are capped. Banks keep absorbing debt. The Federal Reserve expands its role quietly. Confidence is maintained through management. Headlines stay calm, but pressure continues building underneath. The other path is adjustment. Foreign demand keeps fading. Gold accumulation accelerates. Alternative settlement systems grow. The dollar doesn't collapse, but it slowly loses exclusivity at the margins, not through one event, but through repetition. Fewer buyers here, more hedging there, small decisions compounding. Both paths share one assumption: refinancing doesn't stop, debt doesn't pause, and policy responses follow behavior, not the other way around. By the time something becomes obvious, it's already been happening. Here's the insight that ties everything together. Systems don't fail when they run out of money. They fail when they run out of willing participants. This story isn't about a single auction or a single year. It's about a shift from trust to structure, from belief to enforcement. Reframe it this way. The question isn't whether the United States can refinance $10 trillion. It can. The question is what kind of system emerges when refinancing no longer depends on confidence, because once obligation replaces choice, every future decision narrows. The same tools stabilizing the system today increase fragility tomorrow. Yield caps calm markets now. Forced buyers clear auctions now. Quiet coordination prevents panic now. But each solution pulls the next problem closer. This story doesn't end at bond maturities. It continues wherever confidence meets pressure. And the next layer is already forming, whether it's being discussed openly or not. If you want to stay ahead of where this goes next, follow for analysis that doesn't wait for headlines to catch up.